each of us tends to paint a little picture for ourselves, right? But these little lies in trading cost money. And today we're going to talk about 7 things that traders often lie to themselves about. So let's see if you recognize yourself in any of these. The first thing is really very common, and it's I'll wait for a better setup. This is something where, well, what makes us say this to ourselves? I'll wait for that better setup. Sure, it meets the criteria for what I should be trading, but I'll wait for a better one. It's fear. That fear leads us to these kinds of thoughts, and most of the time it just doesn't get any better, you know. Once you start telling yourself this, you end up saying it more and more often. And honestly, the perfect setup is rare. And if you were to wait for that ideal setup, the absolute best one, the top setups, the top situation, you'd only get, I don't know, 5 of them a year. That's just way too few, maybe 10 a year, but you can't really build a business on that, you know. You'll be skipping trades all the time. And once you start skipping trades like that, you eventually stop taking even those top setups, you know. You just start skipping them too. Another very common one is, I'll just make back this loss right now. Yeah, this one, like this loss, I'll earn it back right away, you know. That's also a very common lie traders tell themselves. And it's basically a road to hell, you know. This is not a systematic decision at all. It's an emotional, impulsive decision. It comes more from emotions, from that loss. The loss pushes you into another trade, which might not even fit the setup you want to follow, but the loss drives you into that next trade, and that leads to another loss, and usually it ends with your account being wiped out. Another thing is when we tell ourselves, I'm doing this just this once. Normally I would never do this. I just clicked it now, but it's absolutely exceptional. But it's exactly these exceptions that eventually become routine and the normal standard. So set boundaries for yourself in this regard. Don't make exceptions. And if you really have a strong urge to make an exception, at least write it down in your journal. Okay? Note that you made an exception here, and the journal should serve as feedback enough to tell you whether it really was an exception or if it's already become your standard, you know. And even there, when you write it down, you'll see how successful you actually are with those exceptions. That means it's a kind of feedback for you, either to stop doing it thanks to the journal, or on the contrary, to include it in your portfolio and actually start doing it, you know. But this, like telling yourself, I did this as a complete exception and generally I don't do it, well, that's not a good sign. Then I also hear, the market is manipulated, you can't trade here. Yeah, I hear that very often. It's kind of like we're lying to ourselves. It's more like it's a big excuse, right? It's nothing constructive. It has nothing to do with whether or not you're following your plan. It's just something based on feelings again. The market, it doesn't know about you at all. It has no idea you exist. And honestly, it couldn't care less about you. It's like, I'll compare it to how everyone is so concerned about not having a speck of dust on themselves. But to the market, you just don't matter at all. Yeah, the market doesn't know about you at all. So that's another lie. I have to always be in the market, otherwise I'll miss something. Yeah, that's FOMO like crazy, and that's just not how it is. It's not like that. Otherwise you end up over trading, and I'm not saying you should skip trades. You really should systematically take the trades you have, but it's not about something happening just because you're not in the market. No. For a trader, it's actually the opposite. There's that psychology that tells us traders it's time to wait, you know, to wait for the trade, for the right setup, for your setup. Sometimes it takes a shorter time, sometimes longer, and you can't say in advance how often it will happen. It comes out of some kind of statistics, like how often we have those trades in a month, or depending on what kind of trader you are. But it's not about always having to be in a trade, you know? It's more about the statistics and a little less about the emotions. This is a sure trade, so this one will definitely work out. That's a sure thing. That has never worked in forex, and I don't think it ever will. And it's a huge thing. It's really just based on emotions. The setup can look as good as you want. Sure, there are nicer setups, there are worse setups, or not so nice ones, but there's no certainty in forex. In the markets in general, it doesn't matter if it's forex, crypto, or stocks. Certainty is just, that's what you won't find in the markets. It's a certainty that simply doesn't exist there. So look for anything in the markets, but not certainty, okay? So a sure thing like that, I've seen and experienced so many of those. And really, it has nothing to do with the sure thing at all. It's just either a nicer trade or maybe not so nice, but it's definitely not a sure thing in any case. If I add one more indicator, everything will get better. Well, that's just a huge misconception, and it actually distracts you from the basics. I'm trying to guide you to trade price action. Any additional indicator takes away from that price action a little bit, you know? It focuses your attention on something completely different instead of watching the price. And the price is what's essential for you, how it behaves, how it develops. Don't let some indicator take that away from you. That means, for example, something beeps at you or shows you that something is oversold, overbought, or some EMA crosses over. It's a nice piece of information, but it really has nothing to do with actually entering a trade, or at least it shouldn't have anything to do with it. Entering a trade, exiting a trade, or anything like that. Those are just completely different things altogether. Those are based on completely different principles than classic price action. And it's usually scalping or some similar discipline, which is, again, totally, that's not what I'm talking about here, because scalping is something that's extremely demanding mentally. That's an elite discipline. Only like out of the top 5% of traders, maybe just a few can afford to do it. I don't know, maybe 1 in 1,000, 1 in 100, but it's extremely difficult. So indicators definitely won't get you any further in trading or in the results that you have. Lies that we very often perceive, maybe we don't even notice them, but they very often reflect our results. So it's good to know when we're lying to ourselves and when we're not listening to our emotions or to what our conscious or subconscious is whispering to us.